Well, that certainly escalated quickly. The markets, we got our rate decision, a widely expected rate decision of a rate cut. What was apparently not so expected was the fact that the Fed was going to take cuts off the table for next year. We've talked about that possibility, right? We've talked about that as actually ultimately a good thing, even if it's a bad thing in the short term, creating volatility. But ultimately, it's a good thing for at least the first half of next year if they don't cut rates anymore, because that means the market's doing pretty well and doing well. So we'll get some volatility, we'll get a low point, and we'll bounce, and everything will be back to being fine again for a few months at least. But the market apparently didn't like it today. And so today was a significant day, a very significant. Obviously, it was a significant day, but I'm going to tell you why from a technical perspective it was significant. It wasn't just a big down day. It was more than that. It's going to have some serious implications going forward. So I'm going to break down what those are, why, what the patterns that we're seeing today, why it was so significant. A lot of breakdown patterns that, again, that like I'll say here later, but you typically don't see these kind of patterns in bullish markets, right? And when you're strongly bullish, and you definitely do see them towards the end of very mature bull markets, especially in bull markets that get very complacent like we have been. Again, I'll show you a comparison to the end of 2021. It seems like we're just repeating 2021 all over again, just maybe offset by a month because we don't repeat. We tend to rhyme in the markets because we're all humans. Even in 2021, it's the same humans that are driving the markets as in 2024. Human psychology, but very similar analogs. So we'll break that down as well. We'll talk about the sector rotation as always. And then we'll talk about how to trade a big drop like this. I found a stock that looks very similar to the market as a whole, and we'll talk about how to trade it. So let's go ahead and get started. Today is Wednesday, December 18th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. Alright, if you're watching here on our blog, check out some of these other things, including our Market Outlook live video. This is where I take a look at the old Market Outlook trades we've done in past videos, see whether we should stay in them or get out of them. We talk about why. We also put on today's trade idea already before the market closed at 3:30 Eastern Time. And you get to this class but just by clicking on this image. Come down to the bottom, click this heart. It opens up this tab. Hit that like button. Same thing here. Click this thumbs up icon. It opens up this tab. Scroll down and hit today like button on today's Market Outlook. Again, that helps get our content out to all of our followers on those platforms. So thank you to those who do that day to day. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator, as we always do. And you can see the bull tag. We got much different bull tag this go around. This is by far the lowest. We're below the moving average on this particular bull tag. The last two are pretty deep, which technically were deep enough to start new intermediate declines. 1.25% there, 1.25% here. Usually about the 1% mark is a good level. But this one down 2%, over 2% below the moving average. So big bull tag there. As you can see, the intermediate line crossing both the market sentiment line and the 80th percentile. That's why you got the light pink shading. And of course, crossing below the moving average gives you the yellow line, hence the bull tag. That combination is what produces the bull tag. You can see the momentum line dipped to extreme lows, and the near-term line dropped below the 20th percentile. So pretty bearish short-term sentiment there. We never did get above the 60th percentile, so even more bearish of a peak than just a normal bearish peak. So things falling pretty low on the S&P 500. Not, obviously that's kind of the understatement of the year. The Dow Jones Industrial Average, remember, already had produced a bull tag a few days ago. It built on that the last couple of days, but not by a lot. Today it built on it by a lot. In fact, we're down 4% below the moving average. That's the lowest we've been any other time of the past year. In fact, if I go back to 2 years, it's not quite the lowest of the last 2 years, but pretty darn close. The only time we've been lower was during the financial crisis, right? The regional banking crisis that we had in March of 2023. It's the only time that we've been lower. And even at that point, we were getting oversold clusters, and we were at the low of that particular intermediate decline. we haven't even started an intermediate decline yet. We don't even have a single day of dark pink shading in a red line. So it kind of goes to show just how bearish the short-term sentiment is there for the Dow Jones Industrial Average. Of course, your NASDAQ 100, on the other hand, is still looking okay, right? I mean, it's a pretty steep decline here, one of your bigger drops. In fact, if you look at the size of the drop today for SPY, it's the bigger, we have to go back to August 5th to have as big of a drop. We were down 2.91%. Today we're down 2.98. We gapped down that day for almost 4%. Obviously, we only gapped down marginally today going into the FOMC. This is all post FOMC, this particular decline. So one of the bigger drops that we've seen in a while. In fact, again, go back a few years. The last time we were over 3% was in September of 2022. So again, a pretty steep decline there. The Qs, again, over 3%. We saw that back earlier this year in July. Before that, it was going all the way back to 2022 at the end of the year, at the end of that particular correction. You can kind of see here, if I were to go back, because I've shared with you a lot how close we look compared to 2000 and to the end of 2021. Well, 2021, let's see here, right around Thanksgiving, there's the post-Thanksgiving day, we were only down like 2%, and we started to build up to, by February, a 3% decline. Same thing with the S&P. The S&P at the end of 2021, the day after Thanksgiving, we dropped over 2%, 2.25%. Again, we're down nearly 3% today. But that, just like now, we also had a period there where we were pretty bullish on the S&P, but we were not very bullish on the diamonds, right? The diamonds going into that 2000 that Thanksgiving, we were pretty bearish on the diamonds. Had that 9-day out of 11 losing streak, and then again a big 2% drop out of nowhere, right? So similar to what we saw right now. In fact, we had a 9-day out of 9 losing streak here, and then a big 2+% drop again that comes out of nowhere. So very similar. Today's move is very similar to that end of the day move, the Thanksgiving Friday move. Now, when you look at that Thanksgiving Friday, you can see here, if I were to go back to, because remember we had that where the S&P was still holding up and the Dow was on a losing streak. Well, there's that day, and we also got a bull tag, kind of a bull tag. The intermediate line didn't quite fall below the 80th percentile, but we fell a little bit below the moving average by 0.7%. We fell a few more days to the point of getting about 2.5% below, kind of about where we're at now, and then we bounced with one more leg higher. Again, I see something similar happening this particular go around. Very extreme move, as you'll see here when we look at the breadth. Very, very extreme move today of all days. And then finally, let's look at the Russell 2000. And you can see the Russell 2000 here. Let's go back to just a year chart. Intermediate line, this is the first one that has dark pink shading and a red line out of all of them. Again, 6% below us, the lowest of the past year. The intermediate line below the 50th percentile. Short-term sentiment's still bearish, but again, the red line and dark pink shading, again, that combination, especially at this depth. Again, we haven't been 6% below the moving average since right about here, October 2023. But again, we were at the low point of this intermediate decline, and the same thing here in April. In fact, let me draw this line here so we can see it. Minus 6.18. And again, we're just barely crossing the 50th percentile on the intermediate line. But here's some of the other, again, at the low point there. These are all at lows. Here's that same time frame of late November. So here's that Friday after Thanksgiving. Again, dark pink shading in a red line. We were 4% below there, 6% now. Very, very similar. And that started a decline on the Russell that never did recover like it did on the S&P. We got a bear tag when the S&P got its new all-time highs there. But the Russell only got a bear tag, and we maintained the decline. So the Russell might be showing us something going into 2025 that we need to pay close attention to. Let's take a look at the weekly chart. Remember how we were kind of like, oh, we got a lower high. Well, now we have a bearish candle, right? And it's kind of a transition candle. We have a upper shadow and a lower shadow. It's clearly a transition candle. That's a bearish candle so far. We have 2 more days left in the week. So the day's not over. The PPO is still at pretty decently high levels, though it is rolling over. Of course, when you look at like the Russell 2000, that's a pretty bearish weekly candle that we haven't seen for a while. The Dow Jones Industrial Average is also showing a pretty bearish with red arrows, right? So we're below the 10-week moving average. The S&P is not quite yet below the 10-week moving average, which is kind of crazy to think. If you look at the 3 green arrow charts, of course, your Dow and your Russell both have 3 red arrows still, pretty clearly bearish there. The S&P got its first day of 3 red arrows today, and most likely will stay 3 red arrows for a while because it's pretty low on the momentum, and we're well below the moving average. We're not going to get a green, unless we get a big 4% rise tomorrow, we're not going to get a green arrow again on the moving average. And then your Qs are just maybe another day away from getting 3 red arrows. But only 1 red arrow on the Qs. It goes to show just how strongly bullish the Qs were, helping to hold the markets up. Your S&P dropped below the 17 and the 30 today, which by itself is a pretty volatile combination when you drop below multiple moving averages. But we dropped below the 17, the 30, and the 50 today with a lot of volume. Big jump in volume that we haven't seen for a while. The MACD is almost negative. The stochastics is out of bullish territory. Again, looking at IWM, we've almost filled in the gap. And that was a pretty sizable gap between the 50 and the 200. But it goes to show, again, just how, when you got a gap that's that big, it can fill in pretty quickly. You tend to have your bigger moves below the moving averages than you do above them. Let's take a look at some of these other oscillators. So let's start off with the DMI. Let's see, where did the DMI go? It's actually right over here. The DMI. And you can see well above 30 on the negative indicator, below 20 now on the positive. Your ADX is already above 20. So it's turning back up again. So you got the light. We'll have the light pink shading now. It went from light green to light pink, which is not a typical. Sometimes you can go in reverse, light pink to light green. But we got a crossover with the ADX already above 20, so that will be pink tomorrow. Again, the diamonds and IWM look a lot more bearish. You're already above 40 on the negative indicator on the diamonds. And then IWM, you can see you're also above 40. So big time moves. And your ADX is actually below 20 on those. So we may just be getting started on those particular indicators. Your RSI has dipped to bearish levels, right? So we dropped below 50 because yesterday, remember, we were at 57. So we were barely below 60. Well, we dropped below 50 and 40. So this green box now ends yesterday. This is the last day of the green box. It is now there's going to be a red box because we have crossed below the midpoint of the chart and confirmed it with a drop below 40. Look at the CCI. Remember how extremely low we got back here when it was almost at minus 300 in October? Well, this did get below minus 300. So very, very extreme drop. And you can see it's not quite like, remember, getting below 100 is when you start a correction. So we're not anywhere close to correction here, but still, you can see when the correction started over here. This was back in November. When we dropped below the minus 100 levels when we started to see the weakness, and that's kind of what I think. I don't think we're starting a correction now, but I think the weakness is there, right? The signs are there that the big break, like you don't get this kind of breaks and during typical intermediate pullbacks. Let's take a look at the Ichimoku cloud. We do not have a trend anymore, clearly. We dropped to 0 on both these indicators. We're still above the cloud, but the rate of change is now negative. We're below the blue line. The diamonds is below, or at least into the cloud, at the bottom of the cloud. And we have a bearish trend developing there. Intermediate strength trend already. And then IWM also has an intermediate strength trend already developing below -2, above 65. And it is below the cloud. So you can see we're almost a pink shading there too. Dramatically different on those broader indexes that are not so influenced by the MAG 7 plus 2 companies. I guess we could call them the MAG 7 plus 2 if you include Broadcom and Netflix into those plus 2. The Bollinger Bands, we have dipped into below the lower band, right? The bandwidth is relatively low. We dropped below the lower band for the first time since August. Remember, that was the low point of that move, and so was this dip. It was also the low point of that move. We have dipped below the band and the Keltner channel today. The momentum is actually still, see, when we did it over here, the momentum was negative. When we did it over here, the momentum was also negative. The momentum is actually still positive right now. So big, clear break to the downside. Again, the diamonds also see the same break, but you do have negative momentum down there. And IWM, you can see again, big break, big time break. And we never did get the bands inside the Keltner channels. So there's still the green dots there, same thing on the diamonds. And then the same thing on the S&P, right? We never got the band, we never got the squeeze play, and we've already like broken out, uncoiled, without even really much of a coil after this bullish move. Excuse me. Let's take a look now. Let's take a look now at the intraday chart. We did not quite get a new 4-week low point, but this will be the new 4-week low tomorrow, right? So it's not, it's at 0. If we get a new low tomorrow, then the red line will jump to 100. If we bounce up, then the red line will jump to one spot below 100. So one spot below 100 is 94, because this will be the new 4-week low point tomorrow. So big change. In fact, when you look at it from this perspective, well into bearish territory. In fact, to extreme lows. Like when we dip this far, you can see like when we dip this far over here, when we also broke below the moving average, that started an intermediate decline. When we dip this far over here, also dipping below the moving average, we started an intermediate, again, weak intermediate declines, but an intermediate decline nonetheless. So, we haven't, it looks like we're going to get one, and we don't have our 5% tag yet, but it looks like we will. In fact, the Dow Jones Industrial Average does have its 5% tag now, and the Russell 2000 is actually close to a 10% drop, just like that. So things escalated really rapidly there, and you can see that's because, and not only did we have a break into the lower half of the chart. Remember how I said that the range was going to be really small? Now it's not, right? Because now we're not going to jump up on the low. It's going to stay down here, so the range is going to, if anything, get bigger, especially because we're crossing out of the Bollinger Band and the Keltner channel. When you look at today's range and volume, huge numbers. That's why it's like, don't be surprised if we don't bounce tomorrow. That's a huge range, 5 times the average almost. And the volume is more than double the average. Now, granted, those averages are extremely low, but still, like, big time move. Look at that. We are up to, we were so extreme going into yesterday. And today, early today, before the FOMC, we were below 0.7, but boom, we jumped up just like that to 0.91. The volume you can see jumping up, so big time jump, but even more than that, huge jump in the VIX. We jumped above the 105% mark. Remember how in 2022, during an actual correction, we never actually did increase barely above 100%, much less 105. These are all highs. Like we never actually closed, very far. This is about as far as we got above 100%. We never closed below 105%. Well, the last two intermediate declines, the last one and currently this one, have both closed above 105%. In fact, today closing at 114%. So big move there in the VIX relative to the VIX 3M. The VVIX jumping up to 130. Remember how it had jumped up to 100 and we were like, something's up here? Remember how the skew was up to quite a bit? And we said, hey, something's got to happen here because the skew is saying that something's going on, that the market's concerned about not just a little down move, but a big outsized down move, like a 2 standard deviation or more. So it's essentially the kind of move we just got, at least in one day, that we got today. All right, that's what the skew was telling us. And so maybe we should have been paying a little bit closer attention to that, right? I haven't heard anybody besides us talk about that here in this particular video, but we were up to 166 yesterday. It will be updated here. It was at 173. It was at nearly a high point. Nearly up a high point there, and the 20-day average is at once is so extreme. Well, now we see why. All right, today's move and potentially even more, we see why, and you see the VIX jumping well up above the number 20, right? Well up above 20, well up above its moving averages, its 200-day moving average. In fact, the highest level it's been since that August 5th day that we saw there. So a big time jump, and if you take, and right at the very end of options expiration too, when you look at it on an options expiration cycle basis, again, we were talking about the very small range we had going into, but boom, just like that, we have our big jump. We saw that again in 2021. We didn't finish there in that November timeframe. We ended up coming back down, but we had a big jump up to 40 during that expiration cycle. And again, it makes you wonder if this something similar is happening right now, where again we might get a little bit of a bounce into the end of the year after maybe a couple more days of down days, a red tag on the S&P. But a break like this, when you see a move like this, again, this is not the type of move you see in bullish markets, right? You don't see nearly 3% declines in bullish markets. They either are washout lows on intermediate declines you already have, like in this case. Remember, in that case, we actually finished higher than the open. That's how much of a washout it was. That this is not the kind, because of that huge gap. This is not that kind of move. This is like I said before, similar to the end of 2021. This is the kind of move that breaks bull markets. It doesn't necessarily end it, right? It doesn't necessarily mean that we're going to go into a bear market now or even into a correction now, but it typically breaks the complacency and the small ranges and small volumes that we see, and starts to increase the ranges and volumes. And I said before that when the Fed takes rate cuts off the table, that would increase volatility. Well, they did that today. They took rate cuts for next year pretty much off the table. It didn't increase volatility. That will produce volatility for the markets to the tune of an intermediate pullback. I don't think that this will be the end of it, though. I think we'll still get another green tag, right? We'll still, after we eventually do get a red tag on here of a 5% number or more, probably right around 5%, that we will get another green tag going into next year, because the fact that the Fed's not cutting rates next year is a good thing for the markets. It's a bad thing in the short term, as we've seen today, and the skew is all about that. And the VIX too, as it was ramping up, the VVIX is ramping up the last week. But it's a good thing for the early part of 2025. But ultimately, again, we are very late cycle. And I do think they start cutting rates, and it won't be a mid-cycle adjustment or a soft landing by the end of next year. But today is this kind of move kind of tells you, very similar to the Friday. Remember that Friday post-Thanksgiving in 2021, part of the reason why it was only down, a couple percent this day right here is because it was only half-day trading. Now, technically, this was only a half-day trading too, as we didn't trade very much in the first half as we were waiting the FOMC, but still, same idea. And so let's talk more about now what's kind of driving this. All right, now let's talk about what's driving this price action. Let's go. Obviously, we know what's driving it today, but let's take a look at it on a 3-month basis. Well, let's look at it today first, just on its own. As you can see, the Qs are still even with today's loss, are the biggest driver today, or biggest driver of the past 3 months. But if you look at just today, not the story. The Qs are down 2%. The dollar is up considerably, up 1%. Yields are up considerably. You can see yields. TLT is down since the rate decision is down. It was down going into the rate decision. It's down quite a bit after. And then commodities are also down because of the strength in the dollar. But commodities are outpacing equities across all spectrums, right? U.S. equities, large cap, small cap, international equities. It's outpacing all of them. So, and outpacing bonds too, outpacing both high yield corporate bonds as well as long-term treasury bonds. So only really global bonds are outperforming, and of course the dollar as well. In fact, when you look at the dollar and what it's doing against all the other currencies, let's go to a currency comparison chart. And again, just look at it today alone. So we'll go to 12, 18. So the dollar is up. The dollar is the zero line, right? It's up the most against Norwegian krone, the Swedish krona, the New Zealand dollar, the Australian dollar. So all these commodities, South African rand, these are all commodity-based currencies. Crude oil, soft commodities in the Kiwi, gold with the South African rand, more gold as well in the Australian dollar. Mexican peso is also more commodity-based as well. But then you have like the franc and the Japanese yen, the euros in black, so it's way down there as well. The franc and the yen are outpacing all of these currencies. They're safety currencies. The only one that they're not, outperforming is the Canadian dollar, right? The Canadian dollar, and for that matter, slightly the Great British Pound. But safety across the board, right? The euro is way down. And not just against the U.S. dollar. If you take a look at the euro here relative to the U.S. dollar, it's already been in a big dark pink shading and a red line. Big drop today, right? Down more than 1%. That's a big move for a currency, but not just against the dollar, right? It's also dropping against the yen. Remember, the yen is a safety trade. The euro drops against the yen when we are in safety mode, and that appears to be the case again right now. It has not been the case here lately, but this is a big drop. The intermediate line's already below its market sentiment. The near-term line's crossing below. It's the first day below 60. The momentum line is below the near-term line, and it's in the reversal zone. In fact, it's at extreme lows. So, that's bearish, right? This would be a bearish peak. You got a bear tag. We roll off of it. There's a good opportunity that the euro continues to fall against the yen. And just for from a correlation standpoint, here's the euro against the yen. Here, let's pull up. Let's do it this way. Let's go to a longer term chart and look at it on a weekly basis. And then we'll look at it on a 13 weeks. So say 3-month correlation. Okay, so you can see most of the time it's positively correlated. It was not positively correlated in 2022. The yen was just really struggling in 2022. So the market was down, but the euro yen was going up because of weakness in the yen. But for the most part, you can see it matches. Lately, it's been a negative correlation because we've been dropping. As I mentioned, we hit a bear tag, but we were dropping before that bear tag. And the correlation has been negative, but it's generally positive. And very well could, turn positive again as you can see the euro yen peaked in July as it came down just like everything else did, and the S&P came down as well, and we did bounce along up with it. We kind of here to this peak in November, but the peak in November was a much higher peak than what we saw in July. It was a much lower peak for the euro yen, and now here we are. It's kind of a little bit of a head and shoulders pattern developing here, which could have, again, significant implications if the yen were to strengthen, right? And it would be hard pressed for the dollar, for the S&P to stay bullish if the yen continues to strengthen like that, especially if the dollar as well, the euro-US dollar, also, right? It's been on a significant negative decline here, and generally speaking, it's positively correlated. It only is briefly negative and not very negative when it is and pops back up. Well, it's been very negative here lately as, again, we peaked in July. The euro-US dollar did. It was actually a little bit more into August. We peaked there, and then we've been dropping, and the S&P has continued higher. Hence the strong negative correlation right now. So I would expect that to turn positive again, which would mean that the S&P would most likely follow the pattern for maybe like the peak here on the euro-US dollar. It was in 2021, early part of 2021, May. We're well above that peak in the S&P and nowhere near that peak on the euro-US dollar. So the dollar continues to be the big mover, and you see it here. And I would argue that today's move has a little bit of a blow-off top type move to it. We got that long upper shadow that we said was holding for resistance. The high point was 108.07. We are right at it today. Like, you can't really see it because the tags are in the way, but there we go. So there's that long upper shadow. We're trading just barely above it. The ADX is above 40 still. So I think there's a little bit, because of how we've already peaked on this, there's a little bit of a blow off top type move to this. Again, you see it as well on the 10-year yield. Let me bring the 10-year yield back up here. Give me 1 second to bring that back up. Here we go. So, TNX. So, it's at 4.45%. Remember, the Fed just cut rates 4.25 to 4.5. So we're right at the upper limit of the range. It's going to be hard, barring a significant increase in inflation expectations. It's going to be hard for the 10-year yield to exceed this level, right? If you look at the yield spreads, which remember were largely negative, they are at their higher levels now. Coming off, we were at 0.17 before the cut. We're coming off of its higher level, and here it is at its highest level, up to 0.13. Like, we are well above zero on this. So remember, the market doesn't like a yield spread that's rising. So we really want this to peak and roll over. But right now it's rising, and you can see what's happening, right? The 3-month is not doing much of anything because it's going to stay here until the Fed makes their next rate decision. But the 10-year yield is rising back, up to that level, up to the top end of the rate cut. But it will be limited by that. Again, barring inflation expectations, which with DBC dropping, I don't expect inflation expectations. In fact, I think right now commodities are reflecting more of a deflationary expectation, more so than an inflationary expectation. Remember back in 2021, when we were so bullish, we were well above the 200-day moving average and rising. Big time inflation move, right? Commodities are a big function of higher inflation levels. We've been below the 200-day moving average for the last 2 years, 23 and 24. And that hasn't stopped the S&P from getting 20+% returns for 2 years in a row. But we are back below that 200-day, and we're moving lower. And we're below the 200-week, and we're falling down too. So the 30 is crossed below the 50-week. The 50 is crossed below the 200-week. Like, we are in a kind of a quote-unquote death cross environment here. From a bear market standpoint, that would be a bear market type move when the 50-week crosses below the 200-week. So again, probably more reflective of deflationary expectations from this market, right? From the commodity market, more so than inflationary expectations. So as a result, I do not expect the 10-year yield to get above 4.5%. If it does, it will be very marginal and be very temporary, right? Just kind of a market move more than anything. But it won't be a reflection of rising inflation expectations, which is what it would need to be to maintain a run above 4.5% and really get the yield spread up to a much stronger level. Let's take a look at what's dropping, what's from a sector rotation, how things are rotating here today, just today. So let's come here to December 18th. You can see a big drop in discretionary. Remember, that was the big winner. Real estate really dropping as well with rates rising, right? That doesn't benefit these rate-sensitive areas. And XLK really dropping too, exceeding the drop in the S&P. Your safety trades, utilities, staples, healthcare, all outperforming the market, holding up better than the others. XLK was actually doing pretty well going into the rate decision. Big drop coming out of XLC as well. Big drop in both of those coming out of it. As you can see, again, we maintain because everything's dropping, so you have a really, really bad breadth now. I mean, like, we haven't been below minus 100 since the low point here of that April pullback, and before that it was the low point of the banking crisis, and before that it was the low point of the correction. So the getting below minus 100 is a huge, huge deal. It's typically an extreme level, and that's not the only extreme in the and when you're looking at the breadth indicators, looking at some of these other breadth indicators, look at the new high or new lows. We had jumped up above 160 yesterday. We're at 143 right now, looking at about 352 total between the two. So you're going to get a pretty decent new highs and new lows number. This number here, this is going to be pretty negative again today. But you look at like the number of stocks above the 50-day moving average. That's a plummet down to 130. This is the lowest level we've seen since last fall when we were in a steep decline. Lowest, and before that, I mean, all these other, like, we didn't even get down there at the end of 20. Well, I guess we kind of did during that 5% pullback. But you can kind of see here during this move, we got down to 146 in that November timeframe, that late November, early December. That what I told you yesterday was we have an analog to. We got to 146. We're at 130 now. We're even lower now than we were then. The number of stocks above the 200-day moving average plummeting, well below 300. The first time all year we've been below 300. First time we've been below 300 since this whole thing rallied off of this low point. You can see we also dipped below 300 at the over here at the end of November, beginning of December. We dipped to 269 there. So again, very similar. Breaking below, being above 300 is That's a bullish market. And when you break below it, now we're not so bullish anymore. And you can see the average back then when we broke below it in December was even higher then than it is now. It was at 328, it was at 370 versus 353 now. So not much higher. If you can follow my cursor all the way to the right, not much higher than we are now, but you can see similar, right? Very similar. So big extreme drop in the breadth, a huge drop. So and if you look at the ratio here, that getting to these levels typically suggests we are way overblown on the selling. Excuse me, on the breadth. Again, you can see it here. Way overblown. It's not the highest level, but it's a very, very strong level. So there's a chance that we bounce right off of this because of, again, how extreme the breadth has been. Like, we still don't have a pullback, right? We still don't have our 5% pullback, right? We are at 2%. The Dow Jones Industrial Average is at 4.6, so it's still not at 5%. The Russell is at 7%, so it does have its 5% pullback. But the S&P does not, right? So we don't have a red tag yet. We're not even halfway there yet. So there's a good chance that we kind of bounce right off of this because, again, how extreme it's been. Because similar to, again, what we saw, again, at the end of November, beginning of December, we also didn't drop. We didn't get a 5% tag before we rallied up to the upside. So I think we're going to see something very similar now to this that we saw back, now that we saw back then. During this time frame, probably more like this one, right? This was our first down day. That was the Thanksgiving day, that half day where we were so bullish. Remember, the Dow was on a losing streak, and I mean, this period of time was almost exactly the same that we saw right now, as I showed you in yesterday's video. Well, this looks like today. So if we follow up, then we could get to 5% if we follow up a little bit more. But you can see that was like the extent of it, and we went up to new highs before things fell apart, and that's the kind of pattern I expect that we'll see coming, going into the next few weeks, going into the end of the year or into the beginning of next year. All right, that brings us to our trade idea of the day, and we'll take a look at KKR. You can see KKR is kind of looking like the market, right? It's been bullish for a long time. Got a bull tag yesterday after getting one last week, and then really built on that today, obviously with a 5% decline today. Very bearish short-term sentiment. The intermediate line crossing. You can see we're at the lowest point below the moving average we've been all year. So more bearish than any of these other bull tags we've gotten. More bearish than even the intermediate decline that we got down there. So more bearish than what we've seen here in a while. If you look at its weekly chart, you can see we got we've been so bullish, and the PPO is so high. It's not in the 90th percentile anymore. It was actually until just a minute ago. But we're still 20% above. The gap here is still 20%, but we got a red arrow now. It's not our first red arrow of the year, but again, it's one of your bigger candles that we've seen for the year, besides this one coming off of earnings here. But you can see a long lower shadow. This one's, one of the bigger bodies that we've seen without that long lower shadow. Long lower shadows, long upper shadows, hard to build off of that. Easier to build off of this week, and unfortunately to the downside in this case, easier to build off of that kind of a candle than what we saw earlier in the year. If you take a look, after breaking the 17 and the 30 yesterday, we broke the 50 today. The MACD is negative, stochastics is in bearish territory. There's a big gap in volume here until you get to the value area, the point of the 200-day moving average here. So we're in very elevated levels, and the more elevated you are, the more parabolic you've been. And KKR definitely was parabolic, right? The DMI was well above, the ADX, was well above 40. We were below 10 when we peaked. We've been dropping ever since, but now we're above 30 on the negative indicator, below 20 on the positive. The ADX has turned back up before even getting below 25, so it's already above 25. The RSI and the CCI have broken down to bearish levels, below 40, below minus 200 there. If you look at the Ichimoku cloud, we are close to getting into the cloud. Well, actually, we are a little bit in the cloud now. We have a weak trend developing, bearish trend, where we have a very negative rate of change for the first day here. So things have changed there. We've broken today below the lower Bollinger Band and below the lower Keltner channel with some very bearish momentum there. You can see the bands themselves are breaking outside the Keltner channel for the first day. Just for some context, that's the most bearish the momentum has been this year. But if you go back, you can see that's not the most bearish it's been ever, right? So, but it just goes to show just how bearish this drop has been compared to some of these other bull tags that we've gotten here recently. So with that being said, what I decided to do was to do a long put vertical spread, sell the low 20 delta, which is 135 by the 140. You can see that's what the trade ends up being. You can see we're actually already making money on it since we put it on during the Market Outlook Live trade here. If you take a look at where 135 is like right here, so that's where it needs to get to and stay below by January expiration. So we're well on our way, even just in the last few minutes. Since we just barely ended the Market Outlook Live. So, and then that's how much wiggle room we have in case it bounces in the next day or two. We have some wiggle room to work with. And we did close out some other trades that we put on recently in the Market Outlook videos. We closed those out today. And again, you can check out the Market Outlook Live to see which ones we closed out and why, to take some small losses on things before they turn into bigger losses. All right, and that is our trade idea for today. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.